Hey everyone and welcome back to another video. We are already in the month of April. Believe it or not, yes, it's been a very volatile start of the year, although the first month and a half or so were fine. Then from mid-February up until, well, right now, turbulence. Lots of turbulence, so fasten your seatbelt. Although maybe April 2nd, things might change. Now, as you know, these types of videos, we're going to talk about four stocks. We already talked about those four stocks quite a lot because I own some of these names, and in this video specifically, I actually own all of these names. Now, just because I'm going to talk about these four names does not mean that the other ones are not good enough. Actually, right now, I think you can buy 10, 20 stocks. That's how cheap a lot of these companies are at the moment. As always, I'm not here to waste your time, so here are the names. And like I said, yeah, what about SoFi, Novo Nordisk, AMD, Micron, Amazon, Meta, etc., etc.? These are all great companies to own, but I want to focus again on these four names here on the screen. Hopefully you keep watching. If not, leave at least a like, a comment. If you're new here, subscribe as well. We'd really appreciate that, especially if you could subscribe. We are trying to reach 90,000 subscribers, so let's try and reach that. The goal was to reach 100K before my birthday in May. If we can reach 90,000, I'll already be happy. You see, this is what a bear market does. We basically go from 100 to 90. So hit that subscribe button, really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And also a special thanks to FinChat, the new sponsor of some of these videos. You can check out the link down in the description and in the pinned comment as well to get 15% off. After you've tried it out, new users can get FinChat Pro 2 weeks for free. All right, first up, in case you're watching this, well, when I release it, this was basically what has happened on Monday. On Monday, the market actually closed. Well, most of these companies, as you can see, most of them turned green. We started the day very red, and then we've made our way back up. I think the S&P closed green, Dow was green, the Nasdaq was almost break even. But look at this, plenty of green, although, yeah, some of the big tech companies were still red. You know my thoughts on what's going to happen after April 2nd. I still stand by it. Now, let's see if it plays out. All right, so company number one I want to touch on is this one right here. I believe this is the first time I touch on DoorDash on the channel. It's a market cap of $76.7 billion. And over the last 5 years, as you can see right now, it's still down 3.6%. Over the last 3 years, it's up 56%, and over the last 12 months, it's up 32%. And even year to date, it is still doing quite well. So why is it still on the list? Well, because it is a very good company, actually. Now, you will see the trailing PE, 638. Alarm bells. But no. If you look at the PE for the next 12 months, that's already at 38.6. If you look at revenue forward growth here, 2 years, 19.5%. EPS, same period, 52.3%. Very rapid growth, and you will see what will happen actually with free cash flow as well. Now, all of this information, of course, can be found on FinChat, stock research platform, probably the best one right now. Copilot, you can ask it questions just like you're asking Perplexity, Gemini, ChatGPT, Grok. You can ask it questions about specific companies such as DoorDash, Uber, you name it, and it will give you the answers, the comments, the transcript sections, and all of that in the Copilot. And of course, as I've shown you many times in these videos, you can of course look at segments and KPIs. One of their strengths of the platform is that they track company-specific metrics. In this case, segment and KPIs. For DoorDash, you can look at the annual ones, or you can look at quarterly. Of course, the majority of the revenue does come from the United States, but they have been growing internationally rapidly as well. I believe they also acquired a company called Wolt. So that's one of these strategies there. We're going to talk a little bit more about that, but as you can see, growth for United States revenue has been, well, quite something. Since 2018, it has grown at a compound annual growth rate of 79.3%. And of course, internationally much smaller, but that has also grown extremely rapidly. So these are one of the things that you can find here on FinChat. You can look at marketplace monthly actives, DoorDash Pass and Wolt Plus members, total orders, and all of that. This is just for DoorDash. Of course, we have been talking about plenty of these companies, and all of them have company-specific metrics that we can track that you can find on FinChat. So if you want to try it out, again, link down in the description below. New users get 2 weeks for free of FinChat Pro. And if you want to upgrade, use the link, you get 15% off. You support yourself and you support yours truly, moi. So thank you very much. Continuing here, average analyst price target sits 20% higher than the price we're at today for DoorDash. If we look at the PE now here, of course, when you're not profitable, then there is no E. So that's why it's a bit strange right now. But it's pretty clear that from a forward PE perspective, even if this stock is up in the last 12 months and even in the last 3 years, you can see that, well, PE-wise pricing metrics, it is getting better and better. Same thing here for price to free cash flow, price to sales, and EV to EBITDA, all trending in the right direction. Yeah, of course, for some, this might still be very expensive. But if we look at free cash flow growth or the expected free cash flow growth for the next coming years, fiscal year 2025, 17.8% growth, then 33.7% year-over-year growth, and then a bit closer to 30% in fiscal 2027. So, in my eyes, a very, very good company that's becoming more and more profitable. And as we've just seen, generating the majority of its revenue in the United States, but they are expanding internationally, and total orders have also increased quite rapidly over the last couple of years. Then if we look at marketplace gross order volume, that has also gone up quite rapidly over the last couple of years, although, yeah, growth rates year over year are coming down, but last year that was still at 20.2% year-over-year growth. Now, yes, I'm sure you've already seen plenty of memes, right? DoorDash and Klarna, I believe, have partnered up. So whenever you're going to order your burrito or taco or whatnot, you can basically pay in full. Look at some financing options when you order lunch. Yes, that's a bit ridiculous, but hey, optionality. And then the last thing here, just looking at gross profit margin profile and free cash flow margin wise. Free cash flow margin, as you've seen, this keeps on increasing. Gross profit margin has stabilized a little bit now, a bit closer to that 50% mark. Moving on to one of my personal favorites, and that's of course PayPal or PayPal. Now, as you can see, PayPal over the last 5 years, the stock is down 31%. Now, of course, 5 years ago, we started that V-shaped recovery from that pandemic crash. But yeah, 5 years down 31%. Even in the last 3 years, that's still down 43%. And in the trailing 12 months performance, it's basically flat. Year to date, we are down, 24%. Now, PayPal at the moment has a market cap of $64.4 billion, trailing PE 16.3, forward PE 12.9. Ridiculously cheap. You know my opinion on PayPal. It has become one of the largest holdings in my portfolio because risk-reward wise, to me, it's just a no-brainer, although more recently there are plenty of no-brainers. So hopefully we have a brain to take the opportunity and buy quality companies for the long run. And so looking at the average analyst price target for PayPal, that sits 44% higher than the price we're at today. PE compared to the, in this case, almost 10-year mean is, more than half. So more than half than the 10-year mean here. Quite ridiculous if we look at what's expected to happen. And this is basically the story here. Because previously, of course, revenue-wise, we were growing faster than today. But look at something that did not grow. Free cash flow. So you grow revenue faster. Usually, if you have the same free cash flow margin, or maybe if free cash flow margin increases, free cash flow has to go up. That was not the case. Very bad. Now, yeah, revenue is not growing as fast as before, but at least now we're having some growth when it comes to free cash flow, which will enable them to just buy back more shares. Buy, quite a lot of shares, which in the long run will be extremely good for shareholders. And yeah, maybe in the long run, they might pay a dividend, although right now, I do not want to hear the word dividend. Not for PayPal, not for Amazon, not for anyone, to be honest. Buyback first, and then maybe in the future, dividend. If we look at transaction revenue, this as well over the last 10 plus years has grown at a compound annual growth rate of 15.7%. Of course, huge jump has happened 2020 to 2021. then growth did decelerate quite drastically. But in 2024, we did see a small reacceleration. Can that continue? Remains to be seen. I trust Alex Chris. Active accounts, same thing here. We have peaked in 2022, but it does seem like we are going to have a new all-time highs when it comes to active accounts, starting maybe in Q1. And this basically pops that bear case that people keep throwing around in my comment section that nobody uses PayPal anymore, only boomers, etc., etc. Well, again, the data does not lie. Plus, if you really know PayPal, then you know that PayPal owns Venmo. Venmo is extremely popular with the younger generation. So with Venmo, there is also monetization strategies. I've talked about the whole new PayPal One strategy in another video that will be in the top right corner, but I'm quite tired of hearing nobody uses PayPal anymore. No, clearly, a lot of people are using PayPal services, are using Venmo, etc., etc. When in doubt, just look at the data. And then zooming out, we look at gross profit margin that has come down since 2019 and the peak here 2021. So that wasn't great, but again in 2024 we did see it rebound a little bit. I hope and I think we're going to see that continue in 2025. Free cash flow margin, same thing here, that has come down from that 25% back in 2020 to just 14.2% in 2023. But look at this, 2024, we're back here, 21.3%. One extra thing here, specifically with PayPal, look at this. Total employees peaked here in 2021. Since then, that has come down quite drastically. And of course, now revenue per employee goes up. This is going to be a leaner business, doing more with less, becoming more and more profitable. Great business to own, risk reward wise, probably one of the best. Moving on to one of my most recent buys, and that's Nebius Group. Now, Nebius Group right now trades at $21.11, has a market cap of $5.2 billion. Now, Nebius Group got relisted on the NASDAQ late last year. So whatever you're going to see on various stock research platforms, even FinChat, I did message them to try and update those figures, but there are a lot of figures that are just outdated because remember, it's not Yandex anymore. There has been a huge restructuring there, so it's very important that we go and look at the last earnings report, the earnings call, and look at the very much up-to-date data. Very important to note. Now, since they got relisted, of course, the stock did do very well. It went up, I think, to $50 or so. And since then, it has come down quite a lot. And so, in my eyes, a huge buying opportunity if you like these types of companies. Now, usually I'll just skip this because there are only 2 analysts covering this company at the moment. And I think that with CoreWeave's IPO, more people will start looking towards a Nebius. That's just my prediction. So right now, just these 2 analysts, these 2 predictions here, average analyst price target sits 160% higher than the price we're at today. Do with that information what you want. Don't take it serious, to be honest. Now, going back to last quarter, in Q4, the group's revenue was $37.9 million. That increased 466% year on year, driven primarily by the core AI infrastructure business, which grew 602% year on year. Adjusted EBITDA loss in Q4 was $75.5 million, and net loss from continuing operations was $136.6 million. For the full year, the group's revenue was $117.5 million, an increase of 462% year on year. Plenty of cash still also from that raise where Accel and Nvidia did invest in that company. Now, this is the important part because I've seen a lot of comments of people saying, oh, how can you invest in this business? They barely generate any revenue, etc., etc. Again, huge restructuring, but look at what's going to happen in the coming quarters. In Q4, we also focused on building out our sales function, and we are now seeing the results. More clients are coming onto the platform, and our more diversified customer base is already contributing to strong growth in ARR. Based on contracts already in place, March ARR will be at least $220 million, and we have additional potential deals in the pipeline. Given this momentum, as well as the anticipated impact of additional data center capacity and Blackwell GPUs coming on stream later this year, I'm pleased to confirm that our projected December 2025 ARR of $750 to $1 billion is well within reach. You see how fast things can change? So don't be looking at just this small number right here. No, start focusing up on this one and the potential of $1 billion in ARR by the end of 2025. That's when things get extremely interesting, and they are growing quite rapidly, whether it's in Europe or in the United States. They're expanding quite quickly. Look, their business is basically this. Right now, what you're buying is the core business, Nebius, AI-centric cloud platform built for intensive AI and machine learning workloads, featuring both owned and co-location data center capacity with ongoing expansion. Then you've got these ones right here, Toloka, AV-Ride, Triple10. Triple10 is an edtech platform. AV-Ride is the autonomous driving technology for self-driving cars and delivery robots. And Toloka, that is a data partner for all stages of AI development, from training to evaluation, basically a sort of data labeling. Then they also have a 28% stake in ClickHouse, the creator of the popular open source column-oriented DBMS. Now, they say that these are the competitive advantages that differentiate them from other players. I'm not going to read all of them, but basically it's this. Full stack with expertise across the whole AI infrastructure value chain. So they've got 20 to 25% lower total cost of GPU ownership and operations compared to the average GPU provider. They also said the following, and they basically list their competitors, right? GPU clouds such as CoreWeave, Paperspace, Lambda, or hyperscalers here, Oracle Cloud, Azure, Google Cloud, Amazon Cloud. They say here the reasons why or what's their competitive advantage. So if we do the GPU cloud, for example, CoreWeave, Nebius offers more flexibility than GPU clouds in regards to GPU consumption and has a broader service offering fueled by a larger development team. When it comes to the hyperscalers, Nebius provides tailored approach for AI developers and businesses, including SMB-sized customers. Now, they say that the hyperscalers, yes, that they're going to take probably the majority of the market, but a lot of it will be for in-house use, internal use. And Nebius can offer something different. Now, the thing with Nebius is that, well, for them to be a huge success, it has to continue to move extremely quickly, to expand as fast as possible, and to offer the lowest cost per GPU unit. That's basically it. To be honest, I mean, Yandex was worth, I think in 2021, $30 billion or so, a pretty huge company in Europe, yes, a Russian one, but that's the team, that's the expertise that you have here in that small company called Nebius today. And then the last one is Google Alphabet. I just had to put it yet again, despite me doing a video specifically about Google, I think 2-3 days ago. It has to be in this video yet again, because in my opinion, this is one of the big tech players alongside with Amazon. I think Amazon as well, under $200, an absolute no-brainer. Alphabet is just very, very much disrespected. Market cap $1.89 trillion, forward PE 17.2 times. Even the trailing PE here at 19.2 times makes absolutely no sense. Now, like I said, I've already talked about that company in the last video, so here's a quick overview. Average analyst price target is 40% higher than the price we're at today. If we look at the forward PE, 17.1 or 17.2 times, compared to the 5-year mean here of 23.19, it's an absolute joke. Now you might say, yeah, but that's because search is under pressure. Okay, let me show you yet again. First of all, free cash flow is expected to accelerate in the coming years, so there is that. Second of all, if we look at what has happened, even with capex increasing that much or expected to increase, free cash flow is actually expected to accelerate in the coming fiscal years. Yes, in the past, we have seen what has happened here in the past. You can see capex basically increasing quite rapidly, but free cash flow margin has been around 20% or so, with gross profit margin actually increasing over the last couple of years. Now, talking about nobody uses Google search anymore. First of all, that's not true. And if that were true, you would see that impacted in the revenue, in the operating income, and in the overall Google business. Currently, I see no indications of that happening. Plus, I don't know if you've used Google in the last couple of days, probably you have, but you see that when you search something, you have AI overviews. Yes, basically you get an answer already in the first box. AI enabled. You want to know why? Because they have Gemini. Gemini 2.5 Pro is right now benchmark-wise the rankings. It's the best of the best. Currently, things can change quite rapidly. But to tell me that, oh, nobody uses Google anymore, they're behind in the AI, ChatGPT takes their lunch, etc., etc. Currently, I don't think that's happening. And yes, it's true, ChatGPT has been growing extremely rapidly, also thanks to the new image generating, feature. Who knew that this is what you had to do, right? Forget about spending so much or releasing, I don't know, things that can change, someone's genes or whatnot. No, just release an image generator that makes you look like an anime character. That would attract millions of users, of course. And then let's say if Google search does get hit a little bit, I think there are some other segments inside their business that are going to continue to grow nicely. One of them is, of course, Google Cloud. Google Cloud is going to grow quite considerably in the next couple of years, and this is becoming a more and more profitable business for the company. YouTube, same thing here. I believe an analyst at MoffettNathanson said that YouTube alone could be worth $500 billion. He's applying a 10 times price to sales ratio when you look at the revenue for the whole of 2024. So yeah, when you have these types of companies inside of Google, then long-term bets, a Waymo for sure can be worth hundreds of billions of dollars in the future. Last time that we checked, $45-50 billion in valuation. I believe as they launch more and more in the United States and in Tokyo, this, in my opinion, in the future will just be a huge IPO. That's just my prediction here. And so, yes, Google, I think, is a no-brainer, and I will keep repeating the same names again and again if they stay cheap, because it is a huge opportunity. It is a huge opportunity. Bear markets don't happen so often. So when they happen, take the opportunity. I know it's a crazy thing to say, right? We have way more bull markets or bullish years than bearish ones. So when you have a bearish ones, take the opportunity to start adding to very, very good businesses at depleted prices, because that's when you get a lot of amazing returns. 2022, March 2020, trade war 2018. I mean, of course, 08, 09, but I was still in high school by then. But these types of events, that's usually when you make a lot of money. The money for investors is being made in bear markets, but you only feel that during a bull markets, or you only take the profits during bull markets. So enough of me. I think this video is way too long. Apologies for that, but it is what it is. Share your thoughts. What are you buying in the month of April? Let me know down in the comment section below. Hit all the buttons, check FinChat, take it all, and I'll see you all in the next one. Bye bye.